Hello and welcome. In this month's on-demand webinar, OJM Group Principal David Mandell presents 5 tools that can help reduce taxes and protect assets for individuals and businesses. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. OJM is pleased to announce the publication of our newest book, Wealth Management Made Simple. Topics include investment terminology, market history, tips for choosing an advisor, and more. At the end of the webinar, we'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
Hello, I'm David Mandell. So today we're talking about 5 tools that provide both potential tax benefits and asset protection. Let's dive right in and talk about number 1. Now, number 1 is the tool of qualified retirement plans, which I'll call QRPs or QPs, and IRAs. Now, this tool is probably the one of the 5 that most of you already have in place. There's maybe another 1 or 2 that you may already have. I find that most physicians have this or will have this tool or this asset class in their balance sheet in their career. Now, what are the tax benefits? Well, for SEP IRAs and for qualified plans like 403Bs for those of you employed by hospital, 401Ks, profit sharing plans, defined benefit pension plans for those of you in private practice, you get a tax deduction going in, you get tax-free growth, then you're going to pay tax on the way out. But that tax deduction going in, tax-free growth, that's pretty valuable. For Roth IRAs, works the opposite. The money goes in after tax, grows tax-free, comes out tax-free. Both of those have significant benefits. They're just sort of different timing on what those benefits are. And there's some benefit, there's some real planning benefit to having both. Asset protection, what are the benefits? In most states, because this is controlled by state law, we're talking about lawsuit protection, creditor protection, whether you get sued for malpractice or employee claims or car accidents. We're not talking about bankruptcy. That's a totally different discussion. But in the normal lawsuit situation, it's controlled by state exemption statutes, okay? And most states provide the highest level of protection, what we're calling +5. And you may say, hey, what does that mean, +5? I'd encourage you to watch another one of our videos that I did in the asset protection area on our page, which talks about the sliding scale of asset protection, which we've used in our books for physicians for almost 20 years. -5 total exposure, +5 top highest level of protection. Exemption statutes are the +5 top level of protection. Most states provide that top level of protection for both qualified plans and IRAs. Many of them are unlimited in value, but not all. California is an example. I know I'm a member of the bar there. I've been for 22, 23 years. And we have many clients there. Obviously, it's the most populous state in the country. And in California, they do not prevent, the statute does not protect IRAs as well as qualified plans. And a lot of physicians don't know this. They may be still concerned about liability, but they're rolling their qualified plan into a rollover IRA, which they may not want to do if they realize the protection rules. So be aware. You'll see this in all 5 slides. What should you be aware of? Be aware of the limitations on contributions and the cost of ordinary income taxation on withdrawals from QRPs and SEPs. What does that mean? Qualified plans and the benefit of a deduction tax-free growth is significant, but you also have to understand that you're going to pay taxes at whatever income taxes are at when you pull that money out. And in the future, they may be higher than they are today. So it doesn't mean you should stop qualified plans, but when we're advising clients, we really want them to implement a tax diversification plan. How much of your assets are going to be coming out as ordinary income, how much are going to be coming out as capital gain, and how many are going to be coming out tax-free. Make sure you have a tax diversification plan within your retirement plan. That's number 1. Make sure. Number 2, make sure understand the protection rules in your state for qualified plans and IRAs and how they may work to benefit you and how they may be not as beneficial as some other states. That is qualified plans and IRAs. Next, number 2, non-qualified plans. Now, unlike qualified plans and IRAs, where I think most of you listening to this have that plan in your toolbox already, I would venture to guess that very few, perhaps none of you, have non-qualified plans in your asset on your balance sheet, even though it's something you should be considering, and it's something, for example, I've had myself. I've actually funded it fully a number of years ago, probably had it for 7, 8 years. So what is a non-qualified plan? Well, essentially, it's a benefit plan that is not a qualified plan, and that allows a lot of flexibility, which I'll talk about in a minute. Non-qualified plans, from a tax point of view, enjoy tax-free growth and tax-free distributions. You don't get a deduction going in. It's like a Roth, but because most physicians, like myself, because of our income, are limited in how much we can put in a Roth, this becomes like an unlimited Roth IRA. And when I ask most physicians if you think tax rates are going to go up in the future or down, especially since they've come down rates now, and we know they're going up in 7 years under our tax code, the individual rates are scheduled to sunset in 7 years. This is a terrific time to fund Roth IRAs or to fund non-qualified plans, because you get the benefit of putting dollars in after tax when rates are low, and you'll be pulling that out in retirement where rates are probably going to be higher. We know they're going up in 7 years under current law, and long term they may go up even higher than that. So great tax benefit if you can take advantage of it. Asset protection, it's completely dependent on how you set up the plan, how it's funded, and what the state rules are. Many non-qualified plans are protected under an exemption in that state at the top +5 levels we talked about in the last slide. Be aware. Be aware that non-qualified plans have much more flexibility than qualified plans, QRPs. Only doctors or a subset of partners can elect to participate. We have practices where we set up a non-qualified plan where they may have 10 physicians and 1 participates, or 50 physicians and 5 participate. If I'm a doc and I want to put my dollars away into that, great. That goes against my income. I have more planning tools. I've had some tax diversification. I get the benefit of it. My partner right next to me, Dr. Smith, he decides for whatever reason he needs to spend more money. Maybe he's got a lot of kids in college, or whatever the reason is. He can't afford to do it. He decides not to do it. I decide to fund it at $100,000 a year in my non-qualified plan. Partner Jones wants to do it at $25,000. There's flexibility among who can choose, among the investment options, among how much you can put away, and you don't have to offer to any employees. So given all of that, you would think that most group practices would be at least examining this, but we found most of them aren't even aware they exist. So if a non-qualified plan, if an unlimited Roth IRA where you have flexibility among your partners sounds good, you should be contacting us, and we'll be happy to talk to you about it. Make sure you've evaluated these types of plans in your practice. Whether you put them in place or not is secondary. You want to at least have them diagnosed and understand how they may work for you. That's non-qualified plans. Number 3, again, like qualified plans, most of you may, I would venture to guess, own a primary home, and your primary home is both a tax and asset protection tool. Even under our new tax law, some tax benefits remain to your primary residence. Existing $1 million of mortgage interest is deductible. That number is less for new mortgages going forward. The $500,000 capital gain exclusion on a sale of a home still exists for a married couple. Property, along with local taxes, has been reduced to deductible up to $10,000. And again, Carol Foos, my partner, who's a CPA with 25 years of tax experience, has done a separate webinar, a separate video just on the new tax law and what to understand about it. Bottom line is there's still tax benefits to your home. Maybe not as good as they used to be, but they're still there. Asset protection, again, it gets back to state law. Nearly all states protect an amount of equity of a primary homestead in their exemption statute at the highest +5 level. However, be aware that these +5 homestead exemptions vary widely from unlimited in value, like I live in Florida. Florida has a well-known homestead exemption that is unlimited in value. There are some restrictions on certain aspects like geography as an example. But in terms of value, you can have a home that is unlimited in value and protected against all lawsuits and creditors within the rules. Other states have a zero homestead or something around $5,000, which isn't worth much. So you have to understand what is protecting your state, and that is obviously to make sure you understand the homestead exemption in your state. It may affect your overall asset protection plan. That's your primary home. Number 4, cash value life insurance, also called permanent life insurance. I do another video on ViewMedi, which you can find on our channel, where I talked about the 2 everyday tax-advantaged asset classes, and those are real estate and cash value insurance, and it has been that way for decades, including under this new tax law. It didn't impact it at all. Okay, so what benefits from a tax point of view does cash value life insurance have? Cash values, if managed properly, can grow tax-free within a policy. Cash values can be accessed tax-free if managed properly within a policy. Death benefits paid to beneficiaries, generally income tax-free under Section 101 of the tax code. And I think we did another video on this. We certainly have other articles on this. If you have a cash value policy and you want to move it to another one because you like the company better, maybe they're owned by their policyholders like a mutual company, maybe you like their the way the assets grow. Many whole life owners have been moving out of their whole life policy because interest rates have gone down so much, and their returns, their dividends have gone down for a decade or more. You can move between one policy and another without incurring any tax. That's called a like-kind exchange, tax-free exchange. It can be done with life insurance under the code section 1035. You also might have heard of it for real estate under 1031, like-kind exchanges. So you have all these tax benefits to cash value life insurance, which you really don't have in any other asset class. What about asset protection? Just like homestead, nearly all states provide an amount of life insurance cash value that is protected under their exemption statute at the highest +5 exempt level. Be aware, getting the long-term tax benefits I described above for such policies requires ongoing management. It's not one of those just set it and forget it type assets, just like your investment portfolio, just really like your qualified plan. It needs to be managed on a periodic annual basis to make sure that it's being managed from an investment point of view, but also a tax point of view. Okay. Also, the value from an asset protection point of view of the +5 exemption vary widely. From unlimited in value, again, I'll use my state, Florida. We have an unlimited exemption for cash value life insurance, to other states which may have as little as $5,000 or less. So make sure you work with an insurance expert who reviews policies each year, as we do at OJM Group with our clients. I know because I'm also a client with my policies, and understands the life insurance exemption in your state. You want to make sure you're managing it from a tax point of view and understanding it from an asset protection point of view. That is cash value life insurance. Number 5, the final tool that provides both asset protection planning benefits and tax benefits. Captive insurance companies, specifically small captive insurance companies. Tax-wise, these tools, properly structured, maintained, captive insurance companies are granted significant tax benefits under the code, and they have been for, again, decades. I've been working with them when I was practicing law in the late 90s. That's 20 years ago now. Okay, I've seen them and how they've had these tax benefits, and they can still get those. However, as we'll talk about in a couple of bullet points, rules have changed. Asset protection, the reserves, the amounts held in an insurance company, and that's really what OJM Group does. We don't set them up, we don't structure them, we don't provide tax advice on them, but what we do is manage assets inside of insurance companies, and we've been doing that for a long time. And there are rules regarding that. But reserves generally managed inside of insurance companies are generally protected against creditors of the insurance company, its owners, and even the insured company's creditors. So the bottom line is it can be a great place to have assets from a asset protection point of view vis-a-vis the physician. You need to be aware that tax reporting requirements for many types of captives used by medical practices have changed recently. They've become more onerous in terms of the reporting. And audit scrutiny, from what we hear in the industry from folks who are actually managing and structuring these, seems to be increasing. So you've got to be aware of that. Make sure you work with a captive expert in conjunction with your tax advisor in evaluating such a tool for your practice. When we manage assets at OJM Group and they're inside the captives, we get our directions from the client in conjunction with their tax advisor and their captive expert, which is typically their captive manager. So today I've covered one specific topic in wealth planning, which is tools, 5 tools, that provide both asset protection and tax benefits. Thanks for watching.
OJM is a multidisciplinary wealth management firm, and we have worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by visiting ojmbookstore.com and entering the code OJMWEB at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.